morning. You're watching the India Development Debate. I'm Tamanna Inamdar. Why has the budget announcement to explore overseas sovereign bonds become a huge debating point? Well, one of the reasons is because former RBI Governor Raghuram Rajan has questioned the rationale in a strongly worded piece in the Economic Times over the weekend. This is not the first set of questions being asked of the government plan. Several economists have warned that these sovereign funds in external currencies may turn out to be a risky proposition. So what is the entire debate about? Well, first let's begin by understanding what these overseas sovereign bonds are. And now to take us through the debate, we're joined by Madan Sabnavis, Chief Economist at CARE Ratings, Anant Narayan, Professor SP Jain, Institute of Management and Research, MK Venu, Founding Editor of TheWire.in, and our very own Maithili Busnurmat, Consulting Editor at ET Now. Welcome to all of you. I'm hoping you all take us through what the big deal is about. So let me come to you very simply first, Mr. Sabnavis. What is all the brouhaha about? Why are these overseas sovereign bonds suddenly being discussed like they could be a real risk to the Indian economy?
No, I think it's actually hit the headlines primarily because it's the first time that India is going in for raising funds. That is, in case they do so, that is the first time we're actually financing our fiscal deficit by borrowing from the international market. There's nothing really wrong in it because we are getting in dollars, we are saving domestic liquidity. The burden on the RBI reduces to that extent that you don't have to manage liquidity to that extent. But the whole issue here really is that if we have to borrow in an international market, I think the credit rating of India matters a lot. And here we all know that there's been this controversy that emerging markets don't seem to be getting a very good rating, which means that India is nothing else but a BBB minus country. And you will not be able to borrow on the same kind of advantageous terms like, say, if the US government was to borrow or what they are borrowing. Maybe our rate will be something like 300, 350 basis points, plus you add the CDS of another 200 basis points, plus the forex risk which you will have to cover. I'm not quite sure if the cost will really work out more economical, but it definitely looks good that if 70,000 crores of the fiscal deficit is being financed from outside, which means the banks have that much of surplus liquidity. So the whole issue to my mind is that if we're doing so, A, is there a reputation issue which we're going in for because the world gets to know that India is actually borrowing from the international market?
Yeah.
And B, of course, if we make it a habit, there will be a case of our external debt going up. It's already in the region of $540 billion. If that's going to keep increasing by $10 billion on account of the government, then there will of course be a case of servicing at some point of time.
Okay, so the other reason why it's also hit the headlines is because of the comments from former RBI Governor Raghuram Rajan over the weekend, where he argues against the move completely, saying that it's too risky. And let me bring in Maithili into this part of the conversation. At one point, he also puts it down to kind of a sales pitch from foreign bankers and looks at how this has also been pushed in the past but been resisted. Can you give us some perspective about why such alarm bells from Raghuram Rajan?
Well, absolutely, he's dead right on that, because foreign bankers and rating agencies have been salivating at the prospect of getting India to the international bond market. In fact, during the time that Mr. Chidambaram was finance minister, he did try very hard to get India to borrow on the sovereign, come out with a sovereign bond, and this was resisted very strongly and rightly so by the former RBI Governor Y.B. Reddy, because Tamanna, you know, every such bond, there are pluses and minuses, there are costs and there are benefits. You need to do a trade-off of the costs and benefits, and at this particular juncture of our development, the costs vastly outweigh the benefits. In fact, I'd like to bring out, you know, a quote by Thomas Friedman, the well-known Pulitzer Prize winner, and he said there are only two superpowers in the world. One is the US and the other is the bond rating agencies. The US can destroy you by dropping bombs, and the bond rating agencies can destroy you by downgrading your bonds. And that is a very, very correct statement, because bond rating agencies have enormous clout, and let's be very clear that the rating is not decided purely on economic terms. Rating is very much a political rating. During the financial crisis, S&P dared to lower the US's bond rating from AAA to AA plus, because the US's macro fundamentals had collapsed completely. It had become junk status. S&P dared to do that, and as part of the retribution, the head of S&P, who at that time happened to be a person of Indian origin, he was forced to ultimately resign. So let's not fool ourselves. Rating agencies have enormous clout. Rating is a partly economic, and we do not want to become hostage to the whims and fancies of rating agencies. Apart from the entire issue of exchange rate volatility, exposing ourselves to rupee appreciation, then depreciation, all the risks that Raghu had outlined in his piece in the Times of India over the weekend, as you mentioned.
Okay, so let's take a look at some of the reasons that the government wants to go ahead with this and then come to them one by one. One is, of course, that the government argues that India's sovereign external debt to GDP ratio is among the lowest in the world, less than 5%, which puts us in a relatively safe space to go out and go ahead with these kind of borrowings. Of course, the other argument is that with the extent that the government borrows domestically, there's really not much credit left for private companies in the private sector. So let's move some of our borrowing outwards and leave more money to be borrowed internally. Anant, on these points, do you think there's a strong case to tread cautiously with external borrowings, or is it a complete no-no like it has been argued?
Look, Tamanna, the debt borrowings obviously come in with their part of risk, right? When you're borrowing in hard currency, in dollars or euros or in yen, you have to repay in foreign currency with a predetermined interest rate. So that is given irrespective of how you perform. So obviously it comes with a certain amount of risk. On the contrary, if you borrow in equity, which is you bring in money in the form of equity, people who are bringing in are taking enormous amount of risk. You don't have any obligation to pay back either principal or return to them. So historically, if you look back, Tamanna, as a country, we've preferred to let in equity inflows rather than debt inflows. And this is not just a debate for today over sovereign bonds.
Yeah.
Even if you go back 2 decades back to R.H. Patil and other such committees, we've had a preference for equity over debt. My point is we've unfortunately the pendulum has swung far too much to the other side. Look at portfolio flows into debt versus equity. Today we have $60 billion of foreign portfolio investments in debt. We have $430 billion of foreign portfolio investments in equity. Because we've been risk averse, because we've allowed equity investments to come in over debt, today 42% of NSE's free float is owned by foreigners. India Incorporated is practically owned by foreigners. So we've actually sold our equity cheap because we've been scared to take debt. Now, obviously debt comes with risks, but because we've been so risk averse, we've actually sold ownership into our economic progress very, very cheap, which is sad. I think that mix has to change. We have to be a lot more confident about our progress. The authorities have to give us a lot more confidence that they'll manage the macroeconomy. There's a lot of work to be done. But I do think there is a strong argument to rebalance in favor of more debt than equity. Yes, it comes with risks, but at the moment we are not taking risk at all, and not taking risk comes with a cost.
Okay, some interesting variance in views here on the debate. M.K. Venu, let me get in your take before I open it up further. We've tried to simplify this for the people who are viewing as well. So there's a very simple sort of 3-option poll I've put together. So is the plan to raise overseas sovereign bonds as announced in the budget a good one? Yes, no, only in small doses. If you had to pick like that, Venu, what would your option be and why?
You know, Tamanna, I broadly agree with all the points that Raghuram Rajan has raised in his article in Times of India, your group newspaper. And I also go with what Maithili has said, that rating is political. And when it comes to the crunch, rating agencies like S&P and all, as she mentioned, when the US, when there was a huge financial crisis in the US, you were staring at a disaster, but the rating agencies were not didn't dare downgrade the US economy. So now my take on this is that even Raghuram Rajan has himself said in that article that in small doses, perhaps to maybe get a reference rate or benchmark your government sovereign bond and your pricing abroad, so that it serves as a reference rate for other corporates to borrow. Possibly it's fine, But if there is a substantial dollarization of our fiscal deficit, I think then all the other arguments that Rajan has raised, they kick in, right? And Tamanna, so therefore I am making a more nuanced argument.
Yeah.
We have to do our sequencing right. Like Rajan has said that why not create a domestic market first, a robust domestic market for government debt and allow FIIs to
No,
sort of do
but
market
you know,
making
Venu,
here
the
and
small
have
doses.
have a genuine,
Yeah, no, but you know, Rajan's warnings are more sterner than
Hello?
what you're talking about. Like, for example, he says the concern is that once the door is opened, the government will be tempted to issue much more with attendant risks. After all, addiction starts small. So he's likening this to an addiction. So I understand the need for nuance, but beyond the point, you know, there has to be a position.
Yeah, no, I know, but yeah. Yeah, so right. So the addiction is a kind of he's speculating that it won't stop there, and I agree that there could be addiction because of the kind of fiscal deficit that we are running. A fundamental problem, Tamanna, is that today our fiscal deficit, center plus states plus public sector borrowings, has probably crossed the household financial savings number, which is 8% of GDP. So the bulk of the financial, almost the entire financial savings are being appropriated by government borrowings. I think that was the key reason why the government decided to open up the sovereign borrowing market, so that you know there is there's a so the domestic sort of domestic interest rates remain benign. Now I feel that even that is dangerous, because that could lead to the addiction that Raghuram Rajan is talking about. And number two, Tamanna, very quickly, I want to make a political economy argument. When we did demonetization, I remember Prime Minister Modi said that this is being done to bring out a lot of unproductive savings in the form of gold and real estate, whether it is in the black economy or otherwise, back into the mainstream, into the domestic savings for productive investment and for development. My take is that has not happened, because we only addressed cash, as economists even then said. We have not addressed gold at all, and gold, according to World Gold Council, is 40% of all GDP.
What's the point? Yes.
Is in the form of gold held by households, and within that, 40% of our GDP is the quantum of gold lying with Indian households, and of that 15% with various temple trusts, etc.
So tap that
so
first.
my question
You're
is,
saying tap that
why
first.
haven't we explored the measure?
Okay.
And today our savings rate has dropped by 4% of GDP. It's a very serious thing. To address that in the domestic context, we have to do something and not resort to sovereign borrowings to cover up our domestic failings.
Okay, so they're planning to start this, put a framework in place by September. A lot of points which have come in here. Let's now go through the pros and cons and, you know, structure where this debate is standing. Anant, of all the speakers, you seem the most optimistic about these sovereign bonds. Do you think there is an excessive alarm right now about how this will be taken forward? There are no clear signs right now that the government will give into addiction, quote unquote, and you know, go headlong into these kind of external borrowings.
Well, Tamanna, I do think there is room for increasing the amount of debt we bring in as part of external savings. All the points that Venu made are absolutely right. All I'm saying is, irrespective of all of that, we still need external savings. We do need to bring in money from overseas. And within that, the proportion of debt going up can go up. I think we've been very, very low on bringing in debt. And there's a cost of being so risk averse, and we are paying that price in terms of having sold our family heirlooms, India Incorporated, really cheap. Going forward, we should address that. Having said that, there are lots of caveats to put in place. First, it's a myth to say that sovereign bonds today are cheap merely because the dollar coupons are low. That's not true at all. If you actually were to hedge them in the currency markets today, the effective rupee cost would be far higher than where the government can borrow today in the bond market. So it's a myth to say it's a cost saving. It's not. We should keep the option open, but not because of cost. Second, when you open up your markets to sovereign bonds, when you start issuing sovereign bonds, foreign investors will be a lot less forgiving than domestic investors will. Here in India, you can get away with fuzzy fiscal math. You can cook your books. People will nod and wink and say polite things in public places. They will not question your math. Foreign investors, when it suits them, will accept it. When it doesn't suit them, will absolutely tear apart the math if there is any lack of credibility in them.
Yeah.
So you have to be extremely careful about this.
No, but then should we be afraid of subjecting ourselves to those higher standards of scrutiny? And Maithili, I want you to come in on the point that Anant was making earlier about our skew towards equity versus debt, which is, the kind of foreign participation in India Inc. because of our hesitation to raise debt globally or in foreign currencies.
Well, I was a little surprised to hear Anant made that argument, because I thought the entire idea of a globalized world is that it doesn't matter who owns your equity. There is no concept of Swadeshi ownership. In fact, if you look at companies like Unilever is, who owns Unilever? It's owned by basically, institutional investors. So I think this entire idea that we've sold our equity, Indian companies are owned by foreigners, I don't buy that at all. And frankly, as I said, I'm quite surprised to hear Anant make that argument. I thought we moved well beyond that, because debt is very different. Debt has to be repaid. In the case of equity, it is only a dividend, and dividend is paid only when the company makes profit. So in fact, I don't see any problem with equity being owned by foreigners, but I have a serious problem with debt being owned by foreigners. And Anand also said there is a cost to being risk averse. Sure, there is a cost, but the benefits far outweigh the costs. The reason why we escaped the East Asian crisis, the reason why we escaped the Latin American crisis is precisely because we did not succumb to this temptation. And in fact, in a country like ours, which is at best of times, the entire social fabric, economic fabric is stretched so thin, and we are such a relatively poor country as compared to even other developing countries. I think the benefits of staying risk averse far outweigh the costs. Also, it is not as if we are not getting foreign money. Foreigners are allowed to buy into rupee denominated government securities. So if we wish to have more foreign savings come in, let us increase the limit for FPIs and government rupee denominated debt, because there the exchange risk is borne by the foreigner. Why should we bear the exchange risk on behalf of the foreigner? So I think one needs to make this very careful distinction between rupee denominated debt and external currency denominated debt.
Okay, Anand, you want to quickly respond to the points Maithili made?
Very quickly, I agree with her on one point, I completely disagree on the other. On the part she made about increasing participation in rupee debt, I completely agree with her. That's the way to go. Even more than sovereign bonds, we should be opening up domestic debt markets. That's a good point. On the point on equity, here is the point. Look, let's keep FDI aside. If people are bringing in money and setting up factories and manufacturing and giving us jobs, that's absolutely fine. Nobody's going to have a problem with that. Let's look at purely domestic India incorporated. If as a country we are growing at 11-12% per annum, and we can borrow at 7%. If you were the shareholder of such a company, what would you prefer, raising debt or equity? Now, you can argue many ways, but at least the mathematical answer is you will try and take in debt, because clearly you can leverage better, your equity value will grow faster. And that's what every Indian promoter would do, borrow as much as you can at 7% and grow at 12%. As a country, we've done the reverse. We've raised 7 times more equity than debt in portfolio flows.
Okay.
All I'm saying is that mix is wrong. Because of that, today 40% of ICICI Bank, HDFC Bank free float is owned by foreigners. Now, in a growing economy, do you really want to sell ownership that cheap? As a shareholder of this country's economic fortunes, I'm not happy with that mix. I think we can take far more debt as an overall mix. That doesn't mean we do sovereign bonds tomorrow. I agree with Maithili, it should start with local debt.
Yeah.
But the overall mix should change going forward.
Okay, let me get Madan in on this point of the debate. Madan, the skew towards debt versus equity, and then the argument that Maithili makes and others have also made, that if you really want foreign money in, why not raise investment levels for FPIs? Let them invest in in the Indian currency.
No, I think when you're talking of debt and equity, I think we need to distinguish between, or rather I would distinguish between the private sector and the government sector. And here today, when we are talking of the government, I think this issue is divorced from the private sector, where we're talking of private companies being owned by foreigners, which is a totally different kind of an issue. Now, in terms of overall government borrowing, I would of course go with the view that having greater limits for FPI flows into government debt makes more sense, because it's a rupee debt which is being incurred. We're getting foreigners to take the forex risk, and it's not the government of India which requires dollars which is taking a risk.
Yeah.
So in fact, I think we also need to distinguish what is the motivation for having the sovereign bond. If we want dollars, then of course it's a different issue. But today, if the reason is not for dollars but for getting in more rupees from outside, then I think think that the argument is heavily tilted against it.
Okay, let me look at some of the impact that this could have, and one of the things that have been discussed. Yes, Venu, I'm coming to you on one of the things that has been discussed as sort of a warning against this move is the impact it could have on Indian currency and the impact that we face if the Indian rupee depreciates or appreciates. In both cases, there's a heavy price to pay for us, and if you can just lay that out for our viewers as well.
See, Tamanna, somebody, I think Anand said that it's a myth that that borrowing abroad you get very cheap rates, because Tamanna, I heard the same argument when in the bullet train project, when this fiction was being projected that that Japan is giving us a near 0% interest, 0% interest loan.
Yeah.
If you look at the yen, rupee behavior, or yen dollar and therefore yen rupee behavior, in the past we have ended up paying multiple times the amount that we may have borrowed in yen. So this is a big risk, Tamanna, and I think there is a question of timing also, Tamanna. At a time when there is a full-fledged trade war going on between US, China, we don't know where it's going to end. At a time when growth is slowing all around the world. Today, China reported its 27-year low growth, and the US long-term bond yields are at a low. They are lower than the short-term 3 months rate, and many analysts are saying that this could be a predictor of a recession, mild or serious, I don't know. Now, in this kind of a scenario, I don't think this is the right time for India to make a sovereign bond issue. That is one issue. And let us not get carried away by the low 10-year US Treasury rate and take that as a base and say that this ain't going to be cheap, because there are a lot of exchange risk also. Tamanna, the other point that I want to make is that I've been covering finance ministry for 25 years, Tamanna. From the 90s I've been hearing that India has not created a long-term debt market. Why have we not been able to create a debt market? Every budget, if you pick up any budget in the last 25 years, it will talk about debt market, need to create debt market. Now, here is a fundamental structural problem. Because India could not create a domestic long-term debt market to fund long-term infrastructure projects, we have ended up these banks funding, which banks take the 3-year or 5-year money. They've gone into trouble and, funding these long-term projects. And this is, Tamanna, one of the reasons why we are making the sovereign borrowings. The finance minister said in the budget that we also need to create long-term debt market again. For the 15th time I've heard this. So my point is, we have to address these structural issues domestically first, and then perhaps go to the sovereign bond market.
Okay.
No,
but does
we are putting the horse before the cart. We've done nothing domestically.
Does it all have to be in a linear fashion? Does it all have to be a linear fashion? Are we putting the horse before the cart? Venu, I asked you to answer a poll and give you 3 options, which you didn't, but I will come back with it and ask everyone. We'll in fact wrap with that. But before that, Anand, you seem to be outnumbered on this panel in terms of views. Most people are, at least today on this panel, are not too keen on this idea and echo what, in part, in what Raghuram Rajan has said. What do you think the government is thinking? What are they betting on?
Well, the government is clearly looking for new investors and new avenues to raise funding.
Yeah.
I do have a problem if the government thinks this is cheap funding. It's not. I do have a problem if the government thinks it can continue to do this in large sizes. It should not. And I'm votary for small amounts. I'm a votary for keeping options open. I do think we have to increase the amount of debt which comes into the country, be a little more risk open, and that will help us maximize our value and have a little more trust in ourselves. But it has to come with lots of checks and balances. And by the way, when I agree with Madan that debt should not be mixing private sector and government sector, but the reality is, as a country, the cheapest debt we can get in is government debt. sovereign debt. And then we can free up domestic savings for the private sector. Who better than domestic savings to fund private sector investments rather than overseas investors? So I do think there is a role to be played out here. I don't think sovereign bond today makes sense because economically the pricing is pretty bad, even though the coupon might look low. At some stage though, we have to try and increase the amount of debt which comes in. A part of that has to be government debt. And along with getting in that debt, the government has to do a much better job of keeping things clean and bringing credible books of accounts so that foreign investors can come in, and our macroeconomy can be preserved. I think both is required. We need more trust, and the government needs to instill more trust in the entire credibility of the.
I think another point we need to focus on, and let me come to you on this, Maithili, is does this plan of overseas sovereign bonds expose us to rating agencies even more so than before, and how do vulnerabilities play out there? What are the concerns there? You mentioned it briefly earlier in the show, but I'd like you to expand on that thought.
Oh, well, yes, certainly. It exposes us, as I said, it makes us hostage to the whims and fancies of rating agencies. And remember, the two most powerful rating agencies, S&P and Moody's, are both US owned. So they basically, the US, as we've seen, is not above arm twisting its corporates. The corporates usually toe the line of the US government, particularly when you have somebody like a Trump as president. So it really exposes us to the whims and fancies of rating agencies. And as I said earlier, ratings are not purely only decided by economics. They are usually influenced by politics. The last thing we want to do is that, God forbid, if oil prices rise and our macro fundamentals, deteriorate very rapidly, and we fall foul of the US's fancies, the rating agencies could arm twist us like nobody's business. And at that moment, we could see a huge outflow of funds from India. So at this particular juncture, the costs, as I said, hugely outweigh the benefits. We do not wish to play hostage to rating agencies' whims and fancies. The last thing we want to do at the moment is open up sovereign borrowing at this particular juncture. If we wish to have more foreign money coming in, let us slowly increase the limits for rupee denominated governments of India securities, not at all for external borrowings, sovereign borrowings. ECBs, as we've seen, many private corporates which have gone in for external commercial borrowings have in fact burned their fingers. The last thing we want is Government of India also to burn its fingers.
Okay, so Maithili, if I was to give you this little poll that we've put together, and actually for the four of you, so is the plan to raise overseas sovereign bonds as announced in the budget a good one? Yes, no, or only in small doses?
Very bad idea at this juncture. Maybe in the future we'll have to see, but at now, no.
Okay, so it's a no from Maithili. Anand? I know it's a nuanced subject, but let's simplify it and
small doses,
let's see where you
keep
stick
the
your neck
options
out.
open. Yeah, small doses, don't go berserk about it, but keep the options open. Small doses, not a problem.
Okay, so not yes, but you're saying only in small doses.
Absolutely. It's one avenue. Don't do it for cost, but start doing it. Tap new investors, build a benchmark, become fiscally more prudent. It's a good step to get in more debt into the country, but it has to come with a lot of caveats and a lot of protection.
Okay. Madan Sabnavis, I'm going to give you this poll as well. Yes, no, or only in small doses. Is the idea a good one?
No, my answer is no. And two quick points if I can make out here.
Yes,
One
please.
is what Maithili said. We will definitely be working at the whims of the rating agencies. And the second part is about the volatility in the market. See, today the RBI is able to control the yields in the market by buying and selling securities. Once you go into the international market, what the Federal Reserve does will have a greater bearing than what the RBI can do. So most of the time we'll end up fighting.
Okay, Venu, I gave you this poll before. I didn't get a clear answer. What's your answer now? Yes, no, or only in small doses?
I would say the timing is not right at all, and you can do a very small dose just to sort of test the market. But my overall take, Tamanna, is, I agree with Anand.
Yes.
You have to first create a robust
only three options.
domestic debt market to correct the So in a very small dose to test the market, but definitely it's overall it's a bad idea. We can't dollarize our fiscal deficit here.
Okay, only in small doses, say Venu. So divided opinions here, no clear yeses, but the government is pretty sure that it wants to go ahead with at least testing the waters. We'll be watching this space. Thank you so much to all of you for joining us on the first debate. We're taking a very short break on the India development debate. When we come back, as part of our campaign on solving India's water crisis, today we talk about how you can make a difference. We're coming right back. Don't go away.